Hello and welcome to MSI's latest webinar in our 2020 series. My name is Simon Mason and I'm the Sales and Marketing Manager at MSI. And I'm here with Tim Smith, our Director of Oil and Tanker Markets. Today's webinar is for the oil and tanker markets and it is entitled Deep Dive. It will last for 30 minutes and there'll be an opportunity to ask questions at the end. As always, we encourage you to ask questions, and you can do this either by emailing your questions into the address info@msiltd.com or via the Q&A panel within the WebEx platform. Just remember, MSI clients can download a recording of the webinar from our Horizon platform. And now let's move on with the main presentation.
Thank you very much, Simon. And yes, welcome everyone to this webinar. My name's Tim Smith, and I'm going to be running through our oil tanker market outlook in this session. I'll try and keep it to about 30 minutes. We may run over slightly, and then we'll have a Q&A session at the end, so you can send in your questions either via email or on the WebEx chat. So just looking at the agenda for the presentation, we've got a recap of 2020, an update on this year, what's been going on in the tanker markets. We're then going to look at some of the fundamental drivers, some of the extraordinary and unusual drivers behind current conditions, and also our forecast outlook in the second section of the presentation before moving on to our outlook for tanker earnings. And this is for both the crude and product sectors, so we'll be incorporating both markets into this presentation, and we'll also look at a scenario as well. Whilst we're running through the slideshow, I'm also going to use MSI's Horizon platform to illustrate some of the features of the market we're talking about, and also demonstrate some of the capabilities that this system has. So this is a system now that has been up and running for some time. It's an online platform where you can get comprehensive shipping market data analysis, market data forecast reports, vessel valuation tools, the FMV tool. You can run different market scenarios in this, and you can also use that for asset stress testing as well. So we'll look at some of that capability in the context of the tanker market in this session, and I think that will be, I hope, useful for clients to further familiarize them with the system, and also for people who aren't using MSI Horizon to get a fuller view of some of its unique capabilities. So on to the tanker markets then, and a recap and update of 2020. Well, of course, it's been a very unusual year. For tanker markets specifically, it's been an exceptionally volatile year, and you can see that in the chart on the left. Here we're showing spot earnings for a range of tankers from VLCC down to an MR, so both in crude and the product space, and we can see the exceptional levels that earnings attained in Q2 and spiking, peaking in April, before we saw a precipitous drop down through into Q3. So conditions in Q3 much more reminiscent of 2019, certainly mid 2019 levels. We've seen these spot rates draw down time charter rates as well, as we'll see shortly. Why has this been? Well, I'm sure everyone's aware. Firstly, the huge disruption to global oil demand from the COVID-19 pandemic. We're likely to see global oil demand dropping certainly above 8% this year. It was a collapse centered around Q2 as lockdowns were imposed, but we're still seeing obviously ramifications from the pandemic currently. in the tanker market, there were other effects that drove the volatility. Firstly, in response to the pandemic and the collapse in demand, producers such as Saudi Arabia actually increased production initially. And this drove, along with continued high levels of production relative to demand, huge surpluses of oil in the market, which seeped into and saturated onshore storage facilities and moved into tankers as well. And on the right, you can see the spike in floating storage. Again, a narrative I'm sure everyone is fairly familiar with. We started to see that come down across Q3. But recently, given weaker demand, given some of the decline in oil prices, actually we've started to see interest in floating storage re-emerge again. But critically, OPEC Plus did agree to major production cuts back in April, and those have been implemented. And the withdrawal of cargo, withdrawal of oil production in the market has acted like a kind of vacuum on the tanker sector, and we have seen that very steep downward movement in oil tanker earnings aligned with those changes in OPEC plus production, although that isn't the only factor that's driven that. In terms of how MSI's seen the year play out, well, for those of you who joined us back in April, the last time we did a webinar on the tanker sector, at that time, despite the exceptionally high conditions, we were definitely cautious about the outlook. And you can see in this chart, and well, it's the same chart we had previously, but you can see, so in the headlines, some of that caution demonstrated from back in April, and more than caution, we expected a steep drop in the market, and that's certainly happened. We continue to be quite bearish on conditions through Q3. We don't see the market out of the woods yet, given the scale of demand destruction that's happened this year. Back in April, one VLCC was maybe captured the peak of the market, reportedly getting a $350,000 per day spot TCE charter. That vessel was the Sea Splendor. So using MSI's FMV tool, actually let's have a look at the Sea Splendor. It's very easy to use. You can type in names, IMO numbers here, and you can retrieve vessels. Using the FMV tool, you can cross-check the specifications. In this case, the vessel was a 2012 built VLCC. And then you can look at a data set for that specific vessel on current value, fair market value, earnings, benchmark, asset values, both historical and forecast, as well as OPEX, recent sales data, and statistical analysis around our forecast. As you can see, for this particular vessel, for the 1 year time charter rate, over the next few quarters, we are bearish, and certainly going into Q1 21, we've got significantly lower earnings. So let's try and understand why that is, and maybe some of the risks around that view. Firstly, just looking at our track record this year, you can see our quarterly time charter rate forecast. So this is quarterly average data for our 1 year time charter rate forecast for two vessel types shown here, MRs and uncoated Aframax. We've got our forecast from Q2, which is the dotted line, and our most recent Q3 forecast shown as well. So relatively little change given the wide volatility in those forecast outlooks. A significant drop shown between Q2 and Q3 in both cases. So in Q2, we were forecasting something close to what happened in terms of a 30% Q-on-Q drop for the Aframax, for example. So far, our predictions on how the year would play out in tanker markets have been reasonably accurate, but obviously there's continued risk around our forecast going forward, and there's still some downside we expect to come. So as I mentioned before, why has the market moved down so sharply? Well, oil trade, seaborne trade has been a huge driver of this, or a key factor in the difference between the first and the second half of the year. And you can see in these charts crude trade flows from the Middle East and from the FSU, former Soviet Union, primarily Russia. We can see in both cases largely as a result of that OPEC plus agreement and what has been disciplined implementation of that agreement. We can see overall in the second half those volumes have seen significant reductions. Note for the Middle East, China, for example, on the kind of bottom left, the dark blue bars there, you saw that spike in April. So China took in a lot of the surplus that was coming out of the Middle East at that point, and that's had ramifications for the market further down the line. But overall, those volumes have dropped significantly for crude. For products as well, we've seen erosion on the trade side, on the cargo side. So on the left-hand chart, we're showing imports into three regions. We've got the US, that's actually shown in million barrels per day on the right-hand side of the chart. And on the left-hand axis, we've got Southeast Asia and Europe. For Europe and the US, you can see there has been significant reduction. If you look across 2020 versus the 2019 levels, both have seen a substantial reduction in volumes. Notably in Europe in Q3, I think that stands out. Perhaps a bit more for the US overall from those high levels in mid 2019. In Asia, the story's been a little different. We've seen, particularly in China, of course, refining activity and wider oil demand and economic activity recovering faster than other regions. Obviously, it entered into its most stressful phase, I guess, of the COVID-19 pandemic earlier than other countries. But in Southeast Asia, we've seen a reflection of that surplus and increasing Chinese exports, for example, moving into places like Singapore. We've seen other exporters in Asia exporting more products. So some of that increase isn't necessarily reflective of high underlying demand. It's more showing how there's been a surplus. And when we look globally at customs data, trade data, on the right-hand chart, you can see the annual change in quarterly volumes for a range of oil products. So in Q1, you can see that most products actually were seeing an annual decline in volumes even then, based on this data. But we really saw the decline accelerate in Q2, as you might expect. And one of the areas hardest hit was kerosene jet fuel, obviously linked to the aviation industry, where there was almost complete standstill. Other fuels have been hit hard, though. The major clean traded fuels, gasoline, diesel, gasoline and diesel, also saw significant drops. And although it might be that we will see some revision and update to some of this customs data through the course of the year, it's still indicating significant cargo stress and reductions on the product side as well. So if you want to track some of this analysis and some of the data, you can use MSI's reports. This year we've launched a new monthly report, MSI Horizon Monthly, and this replaces our Freight Forecaster report with more charts, more underlying analysis of key flows. For example, some of the charts we've just seen, this is focused on relatively short-term market movements for earnings and asset prices. So for each sector, we look at current quarter plus 2 quarters out. And you can see some of the analysis in the most recent version here. For the tanker sector, we've also got net fleet growth in there. We have asset prices. We also have topical analysis on particular areas of the market that are driving conditions, as well as a large amount of order book data, asset price, sales, cross-sector analysis, and underlying fleet and earnings and prices data. So a really useful monthly report, providing quite a lot of resource that we've just launched this year. Okay, so moving on then to a little bit more of moving towards perhaps the title of this webinar, which is deep dive. So we're trying to, in one case, obviously we've seen the market take quite a deep dive, but also we want to get under the skin of what's driving conditions this year and going forward. So looking at fundamentals, which is obviously the area that MSI spends a lot of time gathering data on, assessing, modeling. Again, using the Horizon system now, you can chart up some of that data very quickly. You can look at key variables. You can scale in and out of databases. Here we're seeing world consumption growth of oil and seaborne crude and products trade. So 2020, you can see that major dip. We're expecting recovery in 21, but notably crude recovery is more muted than in the product sector and than overall oil consumption growth as well. But what we've seen actually is not just those what you might call conventional demand side drivers influencing the market. In fact, what we've seen is some other areas related to the global glut having an effect. And one key area is port delays. So this chart shows you VLCCs and Suezmaxes port delays across a range of regions. And we can see, and this is where we see delays in excess of, or waiting times in excess of 2 days. You can see the spike in Q2. Again, this is across both Asia and Western Hemisphere. We've seen, if you read the industry news, people will be aware of the delays in China, for example, as a result of the glut of oil that was taken into that market. But we've seen delays across the world, in part due to increasing imports and the increased saturation of storage capacity, but also related to the inherent restrictions on COVID, related to COVID-19 in terms of port operations and so on. So this has been a major factor in driving the demand side this year. So if we look just at seaborne trade growth in crude and products combined, which on this chart is the dark blue line, we can see a major dip expected in 2020. Of course, we're not through the year yet, so we will continue to take in data. This is a combination of data and forecast and expectation for this year. We're expecting to see a major dip in trade volumes. But when we look at required deadweight demand, that is translating that trade into deadweight demand for tankers, we're seeing almost no decline in 2020. And you can see over history, these two things are pretty closely correlated. And part of the reason for that is the port delay effect. So the demand this year is being distorted by these disruptions to operations. And it's critical, if you're only looking at demand on a ton-mile basis, for example, you won't pick this sort of thing up. But it's very important in trying to understand what's going on in the market. The counter to that in 2021 is that when we do see the trade volumes recovering in part, we see stronger growth. And as you can see, in combination, we're expecting trade to grow through 21 and 22 strongly. We don't see the deadweight demand picking up. So we see some of these extraordinary factors these being temporary, alleviating in 2021, meaning that the net result is actually we don't see a strong growth in 2021. And that has an impact on our forecast going forward. Though notably in 2022, we see a combination of strong trade growth, and we also see more normal conditions driving deadweight demand upwards. In a similar fashion on the supply side, when we're looking at the fleet tankers, it's important to assess and analyze this two ways, particularly in terms of the last couple of years. Again, we're showing growth in fleet capacity. So this is the year-on-year change in tanker fleet capacity. We're looking at the total tanker fleet, by the way, or everything above 10,000 deadweight here. You can see again correlation with the other variable, which is available tanker fleet, and that's the tanker fleet less conventional removals for things like repair and maintenance, but also the more, if you like, unconventional things that are affecting the market in recent years. Scrubber retrofit, for example, last year. Sanctioned fleets we also had going on 2019. This year, obviously, the bigger impact has been floating storage. So we remove these this tonnage that's not able to trade or isn't available for conventional trading from our fleet assessment, and so we get very different and divergent growth rates for actual fleet capacity and available fleet capacity. And you'll note the available fleet capacity has actually shrunk last year and this year. So that's another reason why we saw such strong conditions in 2019 as well, which was surprising given the overall demand side environment last year. But certainly this year, we've seen again very constructive available fleet position for the market. But overall in 2020, obviously, we're going to see very different conditions in first and second half of the year. Again, as with the demand variables, we see this reversal. We see these as being temporary factors in the market. So in 2021, we see or expect a lot of the tonnage that's been withdrawn for floating storage, for example, to come back into the market. So even though actual capacity decelerates, we see a spike in available fleet capacity. But note, beyond that, we see the tanker fleet being very constructive in terms of fleet growth. So we're expecting a lot of tonnage to have to be removed over the next 5 years or so. And in the long term, that will be positive for earnings. So let's just have a little look at that. So this chart shows you the 20-year-old fleet. And what we've done here is shown what that fleet, or 20-plus-year-old fleet, I should say. So this is tonnage over 20 years old. And we've shown what would happen to that fleet if we didn't have any scrapping. So the blocks, the columns are showing you the dead weight in the different size categories, and the dotted line shows you the proportion of that fleet of the total. So you can see historically that's been around or just under 5%, certainly over the last 5-6 years or so. If we didn't have any scrapping, hypothetically, that would rise to 20%. The solid line shows the MSI base case, retaining that proportion at close to recent historic levels. And that implies a huge amount of tonnage must be removed over the next 4 or 5 years and ongoing. And that's factored into our base case. That's something we expect to coincide with continued market depression next year. So we're expecting much higher scrapping volumes going forward. Okay, so I think we are still more or less on time. We'll have a quick look at our earnings outlook, having assessed some of those fundamentals. We don't have a huge amount of time today, so we're running through some features of the market. You can find all of the in-depth analysis on these numbers in both the Horizon monthly report, but in particular in our quarterly market reports, which run through our 5-year forecast outlook alongside scenarios as well. So we've given you some of a flavour of that, but obviously with everything going on in the market, there's a lot to cover and digest in terms of the fundamental drivers in the tanker sector. When we tie together the two supply and demand sides of the equation and build up what we term the employment rate, so this is the aggregate employment or utilization rate for the market, you can see in this chart, we do expect that utilization or employment rate to drop in 2021. What this chart is showing is the combination of the deadweight demand broken down by, or incremental deadweight demand broken down by crude products and chemicals. It's also showing the supply, incremental supply. This has been reversed, so effectively positive fleet growth is shown here as a negative in order to try and illustrate its influence on the employment rate. So when we see that surge in the available fleet growth in 2021, you can see that's represented as a negative in this slide. So you can get a sense here of how we're expecting the two sides of the tanker market to balance out, or at least evolve going forward. You can see we're positive post 2021, but we still do see some further downside in the near term. I would say, given the uncertainty around how the COVID-19 pandemic, the resultant further potentials for lockdowns and restrictions, the impact of that on oil demand, the impact of that on production and refining and so on, we could well see a slower, more fluctuating recovery potentially. So there are quite considerable uncertainties around this forecast. But beyond 2022, we really start to see that positive influence of a low order book, which is what we're seeing in the tanker sector now, and higher scrapping being much more constructive for the market going forward. And so the employment rate then drives our forecast for earnings. Here we can see our indexed one-year time charter earnings for grouped product and crude markets. So the indices represent handy MR, LR1, LR2 one-year time charter rates for products, and Aframax, Suezmax, and VLCC for crude. And so you can see this is based off 2015. So you can see the dip in 2021. The relative, not much movement in terms of 2020 to 2019. But as I mentioned, we've seen a massive amount of movement across the year. So we're really entering 2021 at relatively low levels. And then we see that recovery going through to 2024. So that's the outlook. I mentioned scenarios. How could we see things change? Well, to give you a demonstration of that and also utilize further the horizon system, we could look at a scenario where, for example, just to give a relatively simple example, is where we actually see oil demand globally recover to 2019 levels in 2021. So we see quite a quick recovery. So here, what you can do is you can input those assumptions into the horizon system. We can take this, which is the 2019 oil consumption levels, and copy them into 2021. It doesn't take very long at all. And now you can obviously put in any numbers in here you like. We can generate this scenario and we'll call it a name. So we'll call it 2019 recovery. And we can then run that scenario. And so what the online system is doing is taking those consumption numbers and running them through our oil market model. So everything underneath this is changing, from refinery throughput to crude imports to product imports to bilateral trades across a huge number of routes for crude and products. That's being recalculated into deadweight demand, and that new deadweight demand is influencing the employment rate, and that is then changing our one-year time charter rate. So let's just check on some of the variables. So we changed oil demand and shifted it upwards to 2019 levels. So if we go into oil markets, we will, and then drill down to, for example, Europe. If we have a look at European oil consumption, you can see we're now at 2019 levels in the scenario versus the base case, which is still significantly lower next year. Now let's see what happens to our 1-year time charter rate. So for an LR1, benchmark LR1, you can see here, that's had a significant positive effect on our time charter rate for 2021. Because we've only changed the demand in that year, we're not really seeing any change beyond that. But it illustrates how you can use MSI systems to run scenarios. And this is quite a unique thing to be able to do, and it's particularly helpful given the uncertainty in the markets we're seeing. It means that you don't have to rely just on the MSI base case forecast. You can run your own scenarios. We're also providing downside scenarios in our reports, and also within the system, you can superimpose those scenarios on set of vessels. So you can store your own portfolio of assets, vessels in the system. Here we can select 4 tankers. We've included the Sea Splendor that we looked at earlier. We have 3 others as well there. And we can then choose a scenario and look at that portfolio under the scenario that we've chosen. So here we're looking at our base case. We've got our asset value there. We can go into the portfolio forecast and look at the combined earnings and values and time charter rates, as well as the breakdown by vessel. And you can split this into further detail for vessel. Note combined earnings there, 67.1. What we can do with this portfolio now is actually change the overarching scenario that's being used. So we can go to our 2019 recovery, one that we just ran, more positive, and we can impose that on our portfolio. And you can run lower case or higher case scenarios as you want to do, or you can use the MSI pre-programmed ones. And there you can see our earnings now have moved up to nearly $82,000 a day. So a significant increase as a result of using that scenario. So it just gives you a sense of the capabilities of the MSI system. And as I mentioned at the start, that hopefully will be useful for clients watching to increase their familiarization. I hope it's been an interesting and insightful webinar for everyone listening in. If you do have any further inquiries, please do get in touch. As Simon mentioned at the start, you can email us at info@msiltd.com. And I think we do also have some time for some questions. So if we have any questions coming in, yes, we've got one coming in. So one question we've got, which is how will oil demand change as a result of COVID-19? And I think that is obviously a big issue. We've seen, if you like, kind of 3 elements that have driven, or 3 perspectives on oil demand really. One was the immediate shock of the pandemic and the government imposition of lockdown. So those things have a direct effect on transport demand, which is obviously the biggest sector for oil demand. The second element is the more conventional reduction in demand associated with GDP growth. When we see recessions, we typically see oil demand dropping. We saw that, for example, in 2009. So you've got a combination of the imposed restrictions and the more conventional GDP-driven oil demand loss. But thirdly, we've also got potential for structural changes in oil demand as a result of changed behaviours, and that's potentially having the biggest impact on longer term demand, as we see things like working from home. We're still increasing, potentially reducing transport demand, and we We also see things, areas of the market such as aerospace, aviation also being impacted and potentially being under pressure for some years going forward. The other thing I think it's also notable is obviously the changes in things like oil production. So we've seen a huge drop. I mentioned OPEC plus, but the response to oil production in US shale crude production is also going to be sizable. So the structural landscape of the market has shifted. And I think we'll obviously be monitoring that. But again, the systems that we have allow our users to actually change those longer term dynamics in the market and adjust and test out different scenarios to look at some of these obviously continually changing conditions. Okay, we've got one more question, which is how do you handle changes in environment? It seems like oil is currently moving into contango. Yeah, so I think that's referring, I guess, to the continued changes in market environments that we see. So today we've been looking at some of our annual average forecasts, but it's important to stress that we've developed our systems to account for and move with fast changes in the market. So firstly, as we saw at the start, we've got the Horizon monthly report coming out, which is providing our clients with up-to-date, more granular market information and forecasts. But it's also important to note that we are updating our FMV and Horizon systems in terms of the earnings and prices you're seeing on there. And that's not just for tankers, this is across other markets, dry bulk, containers, specialist sectors. We're doing that on a monthly basis. So if we see major shifts in the earnings environment, we will respond to changes in our data that you find online. And that's directly linked then to the reports you see, the Horizon monthly report. When we see extreme shifts in the market, as we did earlier in the year, we'll also make exceptional adjustments to our full fundamental market outlook. But for the most part, we are also looking at, if you like, medium-term outlooks, so strategic changes. So I think if you're looking in that context, you don't want to be moving too much with every single variable in the market that's moving week on week. And we're obviously tracking and keeping in touch with what's going on in oil markets, in tanker markets. But again, one of the really useful features of our systems is that they're flexible and they're user driven, and you can account for changes to the market. You don't need MSI to change the systems for you. You can make your own scenarios up and you can look at different variables and how they're changing. So it's that flexibility, user flexibility, that I think differentiates what we do, and also gives our clients flexibility to adapt to changing market conditions. Okay, I think that's all the questions we have. Thank you very much for everyone that's listened. We very much appreciate that, and you'll hear from us soon in our 2020 webinar series. But for today and on the oil and tanker market, I will conclude there. Thank you again. Do get in touch, and we hope to hear from you soon.